Good afternoon, everyone. This is John Person reporting for the Bottom Line Commodity Report. Today's email suggested, which you should have had plenty of opportunity to get a fill, as the market gave us kind of two-sided trading, but overall, gold today, looking at this seasonal trend, we're looking for a reason to get in. Now, this is a weekly chart. These two dojis are a little bit ominous, but I do believe that this seasonal trend that you're seeing here will come into play. Number one, gold has respected its seasonal trend. As you can see here, market rallies, market breaks, market breaks. Seasonal trend has really been accurate. Gold's really been playing up with it. So I like to say that a product that's been in sync with its seasonality will remain in gear or in sync going forward unless something alters that change. And I don't see that anything altering it right now. You know, with last Friday's unemployment report, if things are so great, then there's either no need for further quantitative easing, right? Or the numbers are wrong. Either way, I think people are looking forward to taking maybe some gold off the table, or at least taking something off the table in this seasonal downturn that we at times see. As you may forget, last year, look at this, September, gold had a high of around this 19, as you can see here, gold had a high around 1923, and then 1, 2, 3 weeks later, we're down to 1537. Now, granted, it's taken a long time to get back up there, but if we go back and scroll over in time to 2008, if I can get you back into 2008, here we go. In 2008, literally from the peak to the trough, if you notice that, from approximately 935, let's say, to a low of approximately 680. That's a 30% correction. So that happened in October. So October is known for disastrous turn of events for gold. So I've got two objectives. A, the October options, or first off, looking at futures, I just didn't see an opportunity in a futures strategy. Because, namely, we would have to go to the December options. The November options expire too short of a time period, so we looked at the GLD, which is the exchange traded fund off of gold. So my first measured correction here should be at least a test of this. If we're going to stay in gold's going to stay in a strong range. That's if it will stay in a strong trend. It will be in a range, and so the first test of this old low we saw from 2 weeks ago around that 1736 handle, that 1738, that'll be the first test. If we blow through there, then of course people will be looking at Fibonacci 50% correction somewhere around in here. But overall, this overall shelf of old highs with a point of breakout, as you can see right here, this area here is also that crossover moving average area. So that's all the way down to 1630. Will it get there? I don't know, but it's certainly capable of seeing those types of declines in very short order, as we've seen many times in gold's history. We just haven't seen a decline in a long time. And with everyone being bullish, more importantly, with gold being up where it is, I've said this many, many times, this year, or at least in the last 2 months, we've had more bullish factors affecting gold without it making a new price time or new price high in this time. So if things are so great for gold, why aren't we at least testing and challenging the highs? We might later in the year or after the elections, but right now I think there is some cause of concern for people that aren't sure about what they're going to be paying for taxes at the end of the year. There's a lot of things that that may cause a little small sell-off in the marketplace, and I don't want you to get caught in it. That's why we thought it would be nice to put on a small little position in GLD, a vertical put spread, and so far we're up about 7.5% on the trade. So if you got the email and you didn't act on it, that's all right. I just didn't want to get in a short futures position. As you can see, you know, we generated a daily sell signal yesterday, which was a quasi-holiday. We do have a couple things here, such as new higher highs, but as you can see, it's not been associated with or accompanied by an increase in volume. So this is maybe a little bit of bearish divergence. If we do crack this monthly pivot and we crack this trend line support right in here, that's that weekly low I was pointing to, the next area, you've got all this area in here for the market to fall down to. So that's why I thought the best strategy would be mildly bearish position right now, put on a vertical debit put spread in GLD. I know everyone's probably sick and tired of me hearing about looking at the market internals and looking at the trend of the market, blah, blah, blah. But we did get yesterday a low close doji. But again, it was a holiday. But we certainly followed through. And now we've got two signals, a lot of bearish patterns forming on a potential M-top formation. You take out this swing low right here in the S&Ps, and then I think you are headed for this level. And let me show you something on a monthly basis. I'm going to get rid of the monthly pivots, and let me get rid of all the other stuff I've got on the screen here. Bear with me. All right, so let's take a look at a monthly chart, shall we? And if we take a look at these old highs, this little tweezer top up here, and we draw a little trend line there. So the actual high was 14.19 3/4, and I put a quarter. That's close enough. So the market tipped its hand. Tried to get through it in August. September barreled right through it. So we have 1 month. One single month of closing above, let's call it 14.19, right? That would be these two old highs, which was back in March and April, then again in August. So we had nice little monthly buy signal. So we should see some follow. The only problem with that buy signal, it comes after an enormous rally in the marketplace. At the very least, we're going to see time for the market to come back and test the moving averages. So either the price has to come back down or it's going to pause sideways if it is going to see any further acceleration to the upside. But here's what I'm also looking at. Look what the market stopped at today. Today's low, if we draw a little trend line here off of August's high, we had 14.24 3/4. So far for the month, we're at like 14.27 3/4. So we are playing off of this little high up in here, but I can tell you this, if we get a daily crossing, a closing back underneath this level right in there, so you watch that August high, which is 14.25, let's call it. You get back under that area, I think game back on, and here's the trend line right in there, 14, well, we got to drop that down just a tick there. And I'm sure this line will get it. But this is September, if you notice here, September 13th. This is the day, September 13th, that I'm highlighting right here. This is the day Federal Reserve Ben Bernanke came out and said quantitative easing for the rest of our life, or until 2015, or whichever comes first. All right, so that was the date. So quantitative easing kept us in the game, It's just been, all this bullish news about how great the economy is, blah, 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 and yet we're lower from when Ben Bernanke came out. So we have a potential for what we call an M-top formation. And looking at our advanced declines, we're also not seeing significant follow-through. So even though the market rallied a second time, pulled back, rallied to test the highs, didn't take them out, now we have a sell signal. So this could get a little bit dicey in here. And I'm going to keep my eye on these advanced declines. And also, look at the volume. It is starting to break down a little bit. And why do I say that? Because if you draw a simple little trend line, and you get it exact, you're going to notice that we did break the little trend line here. I would be watching for that on this as well, and I think in the overall scheme of things, it wouldn't be surprising to see maybe a retracement, this 1445 area. We'll look for this to maybe act as resistance early. Let's call it 43 and change. And then overall, if we break that low, then the first stopping point is coming into here, 1402. The next stopping point, then we're getting into 1396, and that's about that base where we started off from. So I'll keep you abreast of the market, but if the market is to remain bearish, we don't want to see it get back above, on a closing basis, these two moving averages, which is around 14, let's call it 1450. All right? So there's our line in the sand. Pay attention to those two areas. Let's take a look at one other sector as well. I want to take a look at the NASDAQ and one more, the Russell. Okay, so the Russell, I had these little trend lines in from quite some time ago saying we have a potential bear flag, and we just had a breakdown in the Russell. So if this is going to be a potential breakdown, it would measure back to about 804, giving us a measured breakdown from the top of the flagpole, which is right up here, and then you measure that from the top of the flag straight down, and that gets you 804, 805 right into monthly pivot support area. All right, now here's the NASDAQ, and you've probably heard me many times mention this coiling effect, and these lines actually have been in the chart on the NASDAQ for quite some time. We're very concerned with the fact that the market's broken out to new highs in price, but not associated by the accumulation of stocks moving with the index. We definitely see that we have a shoulder, head, shoulder formation. We broke the neckline today. Typically, we'll come back up to see if we can test that neckline. So sometimes what happens is the market will come back up, test the neckline, and then if it fails, it's going to be the measured objective. The measured objective is from the head to the neckline and measured down. So if we take a look at that, that would actually just, if you want to trust me on this one, it would be right around this 2672, and 2672 area is way out of our pivot support. We hit monthly pivot in the NASDAQ today, but around 2672 is also 2665, somewhere around in here. This old high, the point of breakout once again. So we want to keep an eye on that. Watch for any type of rally or move back up into, let's call it 2760 area. If the market's truly bearish, it shouldn't penetrate that. It should reject it and move back down. So go up, test the neckline, fail, and as it's starting to roll again, jump on it because you're going to see some follow-through to the downside. One of the culprit was, of course, Apple. And Apple did have that head and shoulders, that neckline. It might come back up, hit the moving average, fill that gap. There's a lot of gaps to be filled on Apple, mainly down here around 600. It wouldn't surprise me. Based on what's going on from the fundamentals, China slowdown and bad exposure, poor sales because they can't get enough of them. Boy, we all wish we had that problem. Long shadow, though, 6.25 should initially offer support, but we've seen in the past where you get long shadows, the market rallies for a little bit and then fades. So don't get trapped in a longer-term pattern. The bearishness, this is a longer-term pattern. Don't get caught up that this little tail here is going to be the savior of Apple for the long term. I think in the intermediate term, we see a rally, come back up, fill the gap, watch to make sure it respects that neckline. And then, if you see the market roll to the downside, then it might get a little bit ugly. How much uglier? Well, we've got a weekly sell signal. It's a weekly low-close doji. The week's not over, but, easily we could see if Apple got into, let's say, this area right in here, 580, from 660 to 580, $80, that much uglier. All right. I hope that information found you well. So we covered gold, what we were doing with GLD and the 7270 spread. Also looking at the health and breadth and the condition of the overall market. Thank you all very much. Hope you had a great weekend, and we'll look forward to any new trading opportunities this week. Thank you.